All right, everyone, this is the last list of 10 stocks going into next week and for the next couple of years. I think are really good plays and buys. Some of you guys have asked me why I don't dig more into each individual stock I'm listing, and it's because I've already broken it up into, instead of going through all 30, I'm doing 10 at a time, and each video is already over 10, 11 minutes long. So I do have enough written down here. I've got pages and pages and pages in my notebook of stuff to talk about for each individual stock, but I don't want the video to be an hour and a half long. That's why I always say if you guys have questions about each stock, feel free to ask me and hit me up. I usually respond within 5 minutes, and I'll do my best to help you guys in any way I can. But before we continue, make sure to hit that like button, hit the subscribe button. Helps grow the channel, helps make me feel good. And today we're going to talk a lot of kind of the sectors we've already covered a lot on. In the oil and gas and the restaurant and kind of mall entertainment sector. So we're going to get in starting off with Blackstone Minerals. Like I said, they're an oil and natural gas stock. They do offer a dividend. They're currently trading at $7.04. Their pre-COVID high was $15.60. They have an extremely strong balance sheet to weather this storm, and have very high margins on their product, leading to high profits, leading to their sustainability. I really like Blackstone Minerals to hit their pre-COVID high of 15, so 100% returns within the next year or two, and then growth from there. I think this could be a $20 to $30 share price stock in the next 3 years, so that's pretty massive gains. One that's in my opinion less riskier but less reward here is Cheesecake Factory. They do offer a dividend as well. They're currently trading at $30.79. Their pre-COVID high $45.24. So they're only 50% away from their pre-COVID high. They're pretty close. And a big reason for that is they've restructured with their digital e-commerce and their selling of cakes, and it's really helped them keep their revenues up during this COVID crisis, pandemic, I guess is the word. But since that they've been able to maintain sales during the pandemic with delivery and everything, I think that just speaks to how the stock is ready and primed to bounce back when we return to normalcy. So I think Cheesecake Factory is a pretty strong shot at its returning to what it was pre-COVID at $45 a share, which would be a 50% return on investment, and I see that in the next 6 months to a year. Next one I want to talk about is Buckle. Buckle offers a dividend. They're currently trading at $18.98. Pre-COVID was $28.52. They murdered their Q2 earnings with their digital sales absolutely booming up. I don't have the exact number, but I believe the Buckle, the store we're talking about, sells, I think it's 2 out of every 3 pair of denim jeans that are worn in America. So they're a huge retailer. I don't think they're going anywhere anytime soon. Again, I love seeing when a retailer has been able to boost their digital sales during this pandemic. I think it just speaks as a huge indicator to how their retail service will perform when we return and malls are allowed to open again. So I really like Buckle to hit that pre-COVID high of $28, which would be about a 60% return, again within the 6 months to a year. Next one I want to talk about, you guys probably haven't heard of this one, is Raven Industries. They do offer a dividend. They're currently trading at $24.92 a share, the pre-COVID high of $38 a share. They're a tech solutions industry, and their reallocation of capital recently, they just published a whole paper on it and their plan for growth and everything. But they basically reallocated a lot of their funds to growth of the company now, which me as an investor loves to see. So I think this is a great growth stock to get into right now for the long term. I don't even want to put a price point on this because technology stocks and technology solution stocks are so hard to project. They can see massive growth or massive loss in a very short amount of time. But I really like Raven Industries as a really low share price stock that I potentially think 10 years down the road, this could be a household name that no one knows about right now. So take a look into that. The next one I want to talk about is Abercrombie Fitch. Same reasons we're talking about all the other retailers. They're trading at $12.31 a share. Their pre-COVID high was $18.83 per share. Their online sales have been incredible during this pandemic. Again, same points as I made for the other retailers. I think that just shows as a really positive indicator for their normal retail sales to grow when normalcy returns. Yeah, and if they hit that pre-COVID high of $18, that would be 50% growth. Again, I see that in the next 6 months to a year time window. Dennys is the next one. Dennys, I guess IHOP, Dennys are the two normal competitors when I think about that quick fast food kind of breakfast restaurant. They don't offer a dividend. They're currently trading at $11.86. Their pre-COVID high was $23.88. I think this is one of the more risky ones we've talked about because Dennys, their cash balance sheet isn't the best. But if you, for me, this is kind of more just a personal lifestyle kind of recommendation because I can't just imagine a world in which Dennys isn't around, So I see Dennys bouncing back to that pre-COVID high of $23.88, but I see it taking a lot longer than some of these other stocks. Instead of 6 months to a year, I would say this is going to take about 3 to 4 years for it to bounce back to its $23, $24 share price. But that would be a 100% return from where it is now. So I think it's a little riskier in the short term, but I think in long term, Dennys is a solid choice right now to play. Now this one, this is out of the 30 I've recommended, I think this is the most potential for gains, and that's Dave & Buster's. And let me dig into it with you guys. So Dave & Buster's, they offer a dividend. They're currently trading at $17.54. Their pre-COVID high was $48.80 a share, so almost tripling what they're currently at right now. And if you didn't know, Dave & Buster's only has 137 stores nationwide. That's not a lot. Not only is there potential for this bounce back for Dave & Buster's to that $48, which would be about 250% returns in the short term, they have so much potential for growth. And I think as COVID, we get a vaccine and we move forward, I think malls that have been hurting and the washout from other stores, because not every single store is going to be able to weather this storm. They don't have the cash balance, right? They're not going to be able to pay their rental agreements with these malls. Some stores and a lot of malls across America are going to be pushed out, a lot of smaller businesses, right? And I think Dave & Buster's, for all the malls that they're not in, are going to be put in. They're going to get a deal with malls because Dave & Buster's is a destination. You don't go to the mall and decide to kind of hit up Dave & Buster's. You go to Dave & Buster's, which happens to be at a mall, and it drives people into your mall. I think Dave & Buster's is a huge growth stock. I think at $17.54, it's incredibly cheap. I think the potential for massive gains is there, and I love this stock. Check it out, do your due diligence, but I think Dave & Buster's is a big winner. Another one I want to talk about, same reasons we talked about all the other retailers, is Dillard's. They offer a dividend. They're currently trading at $30.44 a share. Their pre-COVID high of $84.47 a share, about 3 times what they're trading at right now. They absolutely destroyed their Q2 earnings. Again, a lot of it due to e-commerce absolutely coming up. So again, I love it as a good indicator. And as I touched on with a lot of these retail stocks, the return to normalcy in retail is going to drive these stocks up, but who knows when that'll happen. Like I've said in the past, it's hard for me to speculate, but I'd say by summer of next year, we'll probably be getting back to everything being open and everything returning to normal. So that's why a lot of guidance I give on these, I say within about 6 months to a year, they'll be at or near what they were trading at pre-COVID. Because I think in 6 months to a year from now, we'll be back to the current state of the world we were in pre-COVID. And a lot of these stocks that I'm recommending have performed well online, so that means I think that they will perform well when we return to normal, just to clear all that up. One of the last ones I want to talk about is Genesis Energy, another oil and natural gas pipeline stock. They do offer a dividend. They're currently trading at $5.53 a share. Their pre-COVID high of $23.65 a share. They're based in Texas. It was just one of the reasons I liked them. And again, they deal with oil and natural gas and the pipelining and manufacturing of that. And as we've talked about before, people aren't traveling, people aren't moving around. They don't need oil and gas right now. So if you didn't know, a couple of months back, it was actually barrels of oil cost -$, because they ran out of storage for all the oil they were producing. So the price of oil has just absolutely gotten destroyed, and that's what's destroyed a lot of these oil and gas stocks. But my personal opinion on this is that in the future, we're going to need oil and gas probably at a higher rate than we're using now. As more and more people and more automobiles are coming out, the demand for gas will increase, so the price will increase, driving these stock prices up. So that's why I like Genesis Energy, because if it reaches its pre-COVID high, it'll be a 500% return, which is one of the biggest potential returns we've talked about in a stock on here. The last one I wanted to talk about was Revlon. It doesn't offer a dividend. It's currently trading at $7.81 a share, pre-COVID high of $27.46 a share. News going on with them right now that I don't like, but I'm going to keep an eye on Revlon, and if it drives the stock price down, I'm going to get in at a small position for hopefully big gain potential. Citigroup is suing them for basically Citigroup accidentally wired them $900,000 extra, which isn't a lot of money when you're talking about the size of these two companies. But it's in the headlines right now, and hopefully, the litigations will drive Revlon stock price down to the lower sevens, so you can get in, and then hopefully it'll bounce back to the pre-COVID highs when we return to normalcy of that $27, giving you 400% returns, which would be very good. All right, and then the last two things I wanted to touch on, because a lot of people have been asking me about it, is Apple and Tesla. Their stock splits have already occurred. So if you look at the share price now, Apple, instead of being $500, I think it's 124-ish around there. And Tesla also got cut by a factor of 5, right? So I think it was at 2,200. I think it's at like 420 right now after the stock split. And people have asked me how to play it, what to do. So if you didn't see on, because I know most of you guys are people from Facebook and stuff, right? If you didn't see on Facebook, I got asked that question when I first posted about stocks. I said buy Tesla and Apple as soon as they announced the stock split. When I gave that recommendation, I think Tesla was at $1,400. It's at $2,200 again now, so it was over 50% gains if you listen to that. It's still on the post, so you can go back and check and be like, oh, wow, he actually did say that. And Apple, I think, went up about $50 for about a 10% gain since they announced. So pretty good gains, double-digit returns on both in a pretty short amount of time. I'm pretty proud of myself for recommending them. But people still ask me, now that they've split, what do I do? So my personal opinion on this is that normally when you look at stock splits, usually when they lower the price from the stock split, right, the price usually tends to go up anywhere from about 8 to 12, 10 to 15-ish% in the first 48 hours since the split. So Monday open to Tuesday close, you'll see a pretty good growth rate. And then that Wednesday, people will start taking profits from the stock split. So it'll go down and regulate at its new price. So if I had to offer any guidance for short-term investors, I would say get into Apple and Tesla if you're not already on Monday morning as soon as you possibly could, and then sell right before close on Tuesday. That's what I would recommend. And then if you wanted to go long on Apple or Tesla, I would say, one, I don't want to recommend Tesla. I think it's incredibly overvalued, but I know I'm going to say that. You know, I've got a joke with friends that talk about Tesla, and I feel like the autopilot system in Tesla could go out and kill its driver, and Elon Musk is under a huge litigation and damages and payments, and I think the stock would still go up. Tesla is just a miracle stock. I don't understand it. I don't want to recommend it at all, because at some point there's got to be a fall. You know what I mean? But it's almost sounds stupid to say I think Tesla stock's going to go down at this point, because it's basically proven in the short term it's not going to. But Apple, I think, is a really strong play for Monday market open to get into. And then short term, I think selling prior to Tuesday close is a good spot, and then buying back in midday Wednesday is probably a pretty good way to maximize returns if you wanted to play that. I personally don't do any short-term selling on like that, and I don't own any stake in any of the 30 companies, I guess 32 if you want to add Apple and Tesla. I don't own any shares of any of those companies we've talked about. They're on my watch list, and I did all this research for you guys. I normally wouldn't have looked at any of those companies, but I got asked a lot of questions of what should I look at, how do I look at stocks, where should I even begin, and those were the 30 I came up with. I started at the highest market cap all the way down to the lowest market cap, and I dug through hundreds and hundreds, if not thousands, of stocks to get you guys those recommendations. If you look at the recommendations, most of them are going to be in the oil and natural gas sector and the restaurant sector, and kind of the amusement park entertainment with like the Six Flags and the Dave & Buster's I talked about. And a lot of that's just because they haven't really bounced back like a lot of the other sectors have. You've seen good growth in technology with Apple and Netflix had a big run. Microsoft's gone up. AMD's made a good run. And these technology sectors have had a really great run. You've seen good e-commerce retailers like Amazon just absolutely blow it out of the water. But restaurants and things you would normally find in a mall haven't bounced back at all. And that makes sense because we really haven't seen the resurgence of malls in America. A lot of them are still shut down. So that's kind of where I'm betting on the next rally and rebound to come. I do still think it's going to take some time. I'm not saying put your money in those sectors and you're going to make millions overnight, but I think if you buy in now and hold for the next couple of years, I think you're going to see massive returns. But that covers all I wanted to talk about today. Tomorrow I'll get back to you guys with the what happened in the market today, what's going on and why, and we'll continue from there. Again, if you guys have any questions, please feel free to ask me. I am not a financial advisor. All my opinions expressed in this video are my own opinions and not financial advice. Thank you for watching. Good luck out on the market, guys.